Welcome back to the next live stream on X and YouTube, and I think we're doing LinkedIn as well. With this is the macro micro moment with myself, Arthur Laffer, and my partner Nancy Tengler. And this week we have a very special guest who I've known for a very long time, great economist, Dr. John Silvia. A little bit of background real quick before we bring John on. John, we were talking, he thought maybe 2 decades, 25 years. I think it's more like 30 plus, John. But John was the former chief economist, most recently at Wells Fargo. He was at Zurich, Kemper, and Scudder. He also did a stint with the Senate, U.S. Senate, and the Joint Economic Committee, as well as the House too. I think, if I remember correct, John, for about a year or so. And that was not HUD. That was I can't remember now. But now he's got his own practice and doing a lot of economic forecasting. You see him on LinkedIn. I always see John on LinkedIn posting great articles, great research. You should definitely follow him. Great economist. And John, welcome. Thank you for joining us today.
Well, thank you very much, Art.
And I think Nancy had the first question for John today.
I do. The producers wanted me to tell everyone I'm in Hawaii, Oahu, and on New Year's Eve. I know it's a bottle of Vouv, and we hike up to the top of a hill and watch the fireworks, which are epic. If you've never been to Waikiki for the fireworks, it's unparalleled. But anyway, John, so I wanted to thank you also for joining us, because I know being a friend of Arthur's can be a burden. So thank you for not letting that impact your decision. Here's my question. I have been making an argument that the 90s are that the 2020s are analogous to the 1990s in that we're an environment where productivity-driven growth can keep inflation, though it was higher in the 90s, average of 3%, interest rates kind of 5 to 8%. But we had a Fed chairman that I feel like really understood the power of productivity. So I'd like to hear your view. Is productivity sustainable? And do you think that the Fed is setting policy? I know they're data dependent, whatever that means. But I would like to know what you think about their view on productivity and if they're factoring that into their decisions.
Well, I think that productivity has certainly surprised the markets over the last 2 years. What we look at as an economist is technically we call non-farm productivity. And over the last 4 quarters, that has grown by 2%. In contrast, in the 5 years prior to 2020, that productivity number was 1.6. And in the 5 years up to 2015, that number was 0.6%. So productivity has been the big surprise. And why does it matter? Because as an investor, and I am an investor, when I look at profit margins, and for me as an economist, I look at profit margins relative to the gross value added of a company, you're gaining anything from 12% to 18% in the last 4 years. And then I'll go back finally to one comment you made earlier, Nancy, between us and the pre-show. If you look at the employment cost index in the second quarter of 2022, that number was 5.6%. As of the third quarter of 2024, it's 3.8%. So what is happening from an economics point of view, when you put aside all the data, the basic theme is productivity has improved, employment costs have moderated significantly, and as a result of that, profit margins for many companies have actually improved. So the challenge for productivity is it's hard to measure, but when we look at the data, it clearly has a very positive impact on the overall economy. And that's why it is very difficult for the Fed to be able to judge that economic growth is too fast and will cause inflation in the future, when in fact a lot of that growth is driven by productivity gains.
Yeah, that's perfect. And I just want to add on, Arthur, and then I'll be quiet. I was preparing for a show I was on earlier, and we had two things that were noteworthy. In the Wall Street Journal, there was an editorial. I can't remember who wrote it, but the headline was, "Does the Fed even know what it's trying to do?" And the point is that the Fed's cut 100 basis points, and since then, the 10-year's up 100 basis points, which was probably not the intended consequences. But then you even had Jason Furman come out, pretty much, I think you could say, a reliable partisan Democrat. And he came out and said the Fed should embrace clear monetary policy rules and explain its reasoning for departing from them. And then he added a quote, "Not ready to turn them over to a computer." And my response to that is, I am. I wrote a piece in 2023 called "Time to Replace the Fed with ChatGPT." At least a generative AI learns from its mistakes. So you don't have to comment on that, because I know you probably know all these folks, but that's just my response to what you said. Okay, sorry, please proceed.
But Nancy, I will say, in economics, there's what we call error learning process. And when you find that there are errors, you have to learn from those errors. And I would say, with respect to your comment on GPT, that that's exactly what that program does.
Right.
When things get off a little bit, it starts learning, okay, we need to adjust, rather than arbitrarily saying, okay, the economy's wrong, we need to get back to some old model that may be out of date.
Thank you. That was very diplomatic. Very well done. All right, Arthur.
I guess in light of that last statement, John, so we've had the Fed cut 50 and 25 and 25. And so the Fed funds has gone from, say, 5.5 to 4.5. And yet the 10-year, and I think I wrote this down, I couldn't believe how much this moved, has gone from the day of the first cut, the 10-year was at 373, the 30-year was at a 406. And on the last cut, which was on December 18th, so just less than 2 weeks ago, the 10-year is now at a 4.5, and the 30-year is a 465. And the yield curve looks like it's starting to normalize. It's not the right shape yet, but it's at least getting closer to what you'd expect a typical yield curve to look like on a normal environment, which we haven't seen in a while. Do you think that's really the story here with the Fed? Like they're going to slowly drop the Fed funds, but the yield curve is just going to basically buck the trend, because bottom line is inflation really isn't going to come down to that 1.5% range they want it.
Yeah, I think there are two parts there on your commentary. All right. One, yeah, the inflation number is not coming down. We're seeing an inflation number more like 2.5% on a consistent basis. The core PCE, which is the Fed's target, is more like 2.8% over the last year. But on the second point that you're hinting at is when you have a positive yield curve, that is a signal for positive economic growth. I mean, it's the inverted yield curve that tells you there's a recession. So when I'm looking at, as you suggest, a more normalized yield curve, I'm thinking that's pretty good for the economy. I'll go ahead and take that. I think we're making progress here. And so despite what some people might think of the federal funds rate at 4.5 or so, whatever, as being tight, in reality, the yield curve is telling me we've got economic growth ahead, and I'll take it as a very positive signal.
Oh, that's good news.
Yeah.
And GDP now is still trending up.
But Nancy, that's traditional economics. The positive yield curve has traditionally been a signal for positive economic growth as well as positive profit growth.
Yeah, and to your point on margins, that couldn't be more true from a productivity standpoint, and impact on margins near historic highs. Arthur, I didn't know if you knew that, because you always say you don't pay attention to stocks, which I don't believe, but
other than the ones that I have with you, no.
He's such a kiss up. All right, so you were going to ask about housing, I think.
Yes, John, you've been really good at forecasting housing over the years. What do you think is going on with housing? What do you think is going to happen to housing going forward? Obviously, I keep hearing this. People are like, oh, no one's going to buy a house at interest rates this high. And I'm like, how old are you? when I got in the business, we were buying like 18% Fannie Mae's and Ginnie Mae's and
Right.
20% Ginnie Mae's. It's like, and obviously, in order to have a Ginnie Mae, you have to have someone buying a house. So
So I'll begin. Thank you very much, Art. As everyone knows, and I'm sure on the call, I do participate in the Fannie Mae survey on home prices, and I have been given, the crystal ball being among the best, and there are several of us, best housing price forecasters for the last couple of years. So, with that background, for housing, it's always important to remember first that building permits, not sales, are the leading indicator for housing. And single family and multifamily permits are up versus 3 months ago. Now, as an economist, of course, I always disaggregate or separate out what's going on. And we have to look at quite differently existing home sales and new home sales. And I think everyone on this call appreciates that for many people, including my two sons, they got mortgages at 3 or 3.5%, and they're not ready to move. So existing home sales have suffered because there are a lot of people who have the money, are willing to buy a bigger home or a nicer home or something, and are perfectly comfortable with the house they have given the mortgage rates. So there's a big, I think, challenge there with respect to differentiating existing versus new home sales. And as far as, why, getting back to your point, why are building permits up? Why are new home sales doing a little bit better? Why are home prices up 5 or 6%? Again, to an economist, you go to the fundamentals. And what do we know? Well, the University of Michigan consumer sentiment is up today relative to 3 months ago. I think everyone on this call can appreciate that net household worth, according to the Federal Reserve, is up significantly compared to a year ago or 2 years ago. Barron's had a nice little piece on this a few weeks ago, talking about net household worth at 16.9 trillion as of the third quarter. We can all appreciate that equity prices have done a lot. So I've got people with jobs, better real income, better consumer sentiment, and better wealth. That tells me that's a very positive sentiment for housing going forward. Now, you ask, what's the problem? Oftentimes, I think all of you can appreciate it's regulations and the availability of land. You don't have a lot of excess land that's available in many areas, and you have significant regulations with respect to lot size and certain access to public services. So if you're looking at what is the problem, oftentimes I think it's regulations in some areas that make a big difference and the lack of availability of land. And I will say, if I may, doing a little bit of politics here, I think part of the Trump appeal has been to reduce the regulations in many businesses, and that'll probably be in housing as well.
That is fascinating. Didn't Thomas Sowell write a whole book on how regulations were killing the housing market in California? Or maybe that was just a chapter and I didn't go any farther. But, being a native Californian, native San Franciscan, it was ridiculous when you went to remodel your house, the kinds of regulations that you had to comply with. Not enough lights, too many windows, more lights, just bizarre. Anyway, that was awesome. Thank you for that, John.
You're welcome. Of course.
And what you don't know, Arthur, is that the baby boomers, of which John and I are both members, own half of the net worth in the country, as we should. All right, let's take a break and we'll come back. We want to talk to you about real wages. I know Arthur has a lot more questions, so thank you. Hold on. We'll be right back.
Hey, everybody, welcome back. I think we're going to start this next segment off with an analogy that, and it's going to lead into an actual question, but God forbid I get to the question too quickly. We were talking about how sometimes things seem like they're taking forever. And I was watching bowl games this weekend, and it seems that you could have a whole football game that takes an hour, and then the last minute and a half, and when the score is tight, and all of a sudden they have TV timeouts, and they call all their timeouts, and the next minute and a half takes half an hour. And I was telling John, it feels like the election is, over, and yet we can't get the administration into it. It seems like there's so much stuff that we watch all the time, so it feels like it's taking forever to get the old administration out and the administration in, and to get on with whatever's going to happen, kind of just start moving forward. So, John, the question I would have for you is, judging what happened before in this with this president and his policies, what you've heard so far, what's your outlook on kind of the economy overall, GDP? Are you pretty optimistic that the Fed now forecasts what I think they're like 3.5? Nancy, were they? I can't remember. I know you watched it.
3.2 for GDP.
Yeah, I mean, what do you think about that? What's your kind of prognostication on the economy and where growth's going, employment, production, output?
Well, Art, I do participate in a couple of surveys that are published. One is Focus Economics, and another one is Consensus Economics. So my forecasts are, for anyone who gets those, is public record. The reality is we still have and probably will have economic growth above trend, above the Fed's, the CBO's potential trend. So you're still looking at something like 2.5% at least. I think consumer spending continues to be strong. Non-residential business investment, 2.5 to 3%. I go back to my earlier comment. If you can get some significant deregulation in terms of the financial services and transportation, the auto industry, et cetera, you certainly will get stronger economic growth. And I think we've had enough history since World War II that periods of deregulation are associated with stronger economic growth over more than 2 or 3 years. So I think that's all going to be very positive. I don't see the Fed raising rates next year. Again, going back to our earlier comment that I think the inflation numbers from the Fed's point of view at 2.5 to 3 are acceptable given the low unemployment rate and the positive economic growth. I have no problem with the 10-year at 4.4. I don't see interest rates as a challenge to the overall marketplace. So I'm still going to be very, very positive. And as you know, again, perhaps being a little bit political here, to the extent you change the allocation of resources a little bit more towards the private sector and away from the public sector, which my understanding, that's what DOGE is all about, that is going to continue to add to economic growth and overall productivity.
I love that because, I think what we're now hearing is all the naysayers, John, that are coming out and saying they're not going to be able to cut. It's not going to happen, I guess. And that Elon is going to get crossways with President-elect Trump. I think he's the attack dog. I don't think he's doing anything that's not pre-approved. But I ran across this, and you've been on Capitol Hill, so I'd love your thoughts. But in '97, the Department of Education said that when they were pitching the student loan program, that they would make $6 per every $100 lent. So 25 years later, what's longer than that, 27 years later, and they're losing $8.88 per $100 lent. And the delta is, instead of making $114 billion, they've lost $198 billion. How many places like that do you think there are to cut and just to go in and take the cream off the top, just skim it off the top? What's your thought on that?
I do think that there are a number of areas. Again, I don't know to what extent the incoming President Trump will be willing to use executive orders, will be willing to, do what he can in certain areas. But I think, yeah, there's a lot of areas. I would think that, a lot of federal government leased office space can be restructured. As many of us know, there's always this question about, how much space is actually being used. And we know there's a lot of issues with respect to the subsidies that have gone out in terms of what people call clean energy, which gets back to, a fundamental economic issue. It's benefits and costs. Yeah, I can understand that, there are some benefits, but have we overestimated the benefits and underestimated the costs with respect to some of this clean energy? And so I think a good evaluation there is certainly necessary.
That's awesome. Yeah, I'd forgotten all about the office space. That's an easy off the top kind of expense cut. Yeah, Arthur?
We can just look at we talk about tech a lot, John. Nancy has some great tech stocks in the portfolio, and you talked about Doge and Tesla and and all the companies that Elon Musk seems to come up with daily. Just think about the AI application of AI at the federal government level. I mean, the joke I think I saw one of the memes I saw floating around is that Elon Musk is going to get rid of most of the government employees just by telling them they have to come back to work 5 days a week. But you look at all the hacks of all the telecoms and the government and all the foreign interference, and you're kind of thinking like, God, there's got to be ways to make things more efficient. I mean, who hasn't dealt with the government? And this isn't meant to be disparaging against people that work for the government. I'm sure a lot of them try to do a good job, but they just don't have the resource. I think there was a thing I studied. It was the IRS systems. They tried to upgrade them. It took 17 years to get the upgrade put in. So you have an upgrade that was 17, the technology from 17 years ago.
I would also emphasize, and although again, it may be hard to quantify in some ways, but there was a great article last week in the Wall Street Journal talking about why economic growth in the U.S. is so much stronger than Europe. And basically it comes down to risk-taking, entrepreneurial spirit. Maybe we can characterize, Elon Musk as a risk taker. And that's what, to let resources move from the public sector to the private sector, where there's greater risk taking but more innovation, will improve the productivity and the pace of economic growth in the U.S. But that article was in the Wall Street Journal last week, and I'm sure many people in the audience have probably read it.
Yeah, and I can I ask one more question, Arthur? Did you have another one?
No.
So this notion of sticky inflation, I mean, you said inflation is probably not coming down much. The Atlanta Fed has the sticky inflation number. You probably have a better one to look at. But what do you think is tolerable? I mean, when I got into this business, 0% was the target. Then it went to 2%. What do you think, John? What's your overriding view of inflation?
Well, my overriding view, Nancy, is I've got economic growth at or slightly above potential for the next year or so, according to, the surveys that I look at. I've got the unemployment rate at 4%, and I'm thinking, okay, what are you going to gain by raising the federal funds rate to try to achieve a 2% inflation target? To me, it looks like the economy is operating very well at 2.5% to 3%. And I think it was Secretary Yellen at one time said, let it ride. So to me, let it ride. I think we're doing really well right now. I don't see the need for the Fed to be raising interest rates in 2025.
Yeah, no, I'm with you. And just for our viewers' benefit, inflation, as John is quoting it, is after inflation. I'm sorry, GDP, as John is quoting it, is after inflation. So it's a pretty robust growth rate if you think
Absolutely.
About yeah.
The only comment I would have, and this was beaten into me for many decades, as John and Nancy are probably well aware of. I have PTSD for this. But there's, the 4 areas of economics, and the one that most people wouldn't know the terminology, but incomes policies is what we're talking about today, primarily. And this is all the indirect ways that government messes around with the economy. It's taxes, regulations, restrictions, requirements. So we've talked about banking deregulation possibly, or making rules a little bit easier for banks. That's good. Overall regulatory reform. We've got the SEC as well, John. I think there's been talk about the new SEC chair and how hard things have been. You've got all these cryptos, which I hate the word crypto and then currency, because currency is just supposed to be a means of exchange. So we're not, so we're not paying you right now to be on the program with chickens. That's I got to get them to you first. So we don't want to go back to the barter system, but all these regulatory reforms ultimately add up to pretty sizable, if they're done well, pretty sizable effective tax cuts.
Yeah, I think with respect to President Carter having passed away, several of the things that he did, his major effort was in deregulation. And many people are not appreciate today about trucks on the highway and airlines flying all these different paths all over the place and connecting secondary cities, and just the railroad deregulation. So President Carter did an amazing job in terms of deregulation, and that did help over time lower inflation in the United States.
That is such a great point. Thank you for that. Yeah. Didn't even think about that. Got lost in the peanut farmer part.
I know. It's tough because so much got overrun by Iran and the current high level of inflation. To appreciate, there were parts that were very positive long term.
Well, he appointed Paul Volcker.
Yeah, absolutely.
Yeah.
Forgot about that too. Well, I'm not really old enough to remember that.
Very sly, Nancy. Very sly.
Gosh, I could talk to you all day, John, but you probably have dinner to get to.
Yeah, probably so. But that's okay. This has been a great conversation. Thanks for inviting me.
Oh, it's our pleasure.
Thanks for joining us. We really appreciate it, John. Great to see you again.
Yes, sir.
Yeah. And check him out. Subscribe to his newsletter. I think are you calling it a newsletter?
Yeah, it's just a newsletter.
Yeah.
Simple enough.
Okay. Well, thank you so much. And Art, it's good to see you.
Yeah.
All right.
I'll eat the poi poi or poo-poo or whatever they eat, that stuff they eat in Hawaii.
Okay. I'll have some. Oh, boy. All right. Thanks so much, everyone.
Bye. See you next week.